So we are officially breaking the bear flag on the Nasdaq. The bulls are in shambles as the market is now down close to 14%, past correction territory of 10%, and actually very close to that 20% decline territory, which is considered a crash in the markets. We have about $40 to go until we get there, which would put QQQ down at the 432 level. The S&P 500 is in a very similar structure. You guys can see that we have broken the bear flag to the downside. So there's obviously a lot of uncertainty in the markets right now, a lot of volatility, and a lot of fear going on in the markets. Is this the bottom for the markets? Nobody knows, but in this video, I'm going to cover where I think the markets are, where I think they have the potential to go in the short term and obviously the long term. Then I'm going to go over some stocks that I want to add here at zones that are honestly too good to pass up in my opinion, and I'll include some data in the mix to give you guys a better idea of how you can use data to your advantage and making decisions for your long-term and your short-term portfolios. Let's get into it. I'm going to keep this as brief as possible. So really quickly to start, let's go into some Wall Street banks targets for the S&P. We have Goldman, who lowered their targets for the end of the year from 6,500 to 6,200, and Barclays that dropped their target to 5,900. There's a lot of recession fear, a lot of stagflation risks, and also of course Trump's tariff policies are putting a lot of uncertainty and injecting a lot of fear into the markets. Another thing we can look at is consumer sentiment. According to this UMich survey, 51% of respondents are now making negative comments about government economic policy, and we can also see that hedge funds are hedging portfolios quite greatly to the downside, with a lot of short exposure, actually more now than there was in COVID and the crash that we saw in 2022. And if we look at investor sentiment, we can see these green points are when we have extreme negative sentiments in the market. And currently in 2025, right now, we are seeing another bout of extreme negative investor sentiment. One thing you probably notice in this chart is that every time we have extreme negative sentiment, it is typically a good time to buy for the long term. In 2009, 2011, 2012, 2016, 2019 and 2020, when investor sentiment was very low, as well as in the market crash of 2022. This signaled potential buy zones in the market. And if you did buy in these points and you just waited over time, your portfolios would thank you greatly. So again, like I said before, are we at the bottom in the markets? The answer is, I can't tell you. Nobody knows that for a fact. But what I can tell you is that buying at periods of extreme fear and buying when investor sentiment is low and buying when the S&P and the Nasdaq are down below 10% is typically a great time to buy for the long term. We get a 10% correction in the markets on average every 2 years, and we get a 20% correction in the markets on average every 6 years. So if you simply are patient and wait for these times like we have currently right now as we speak, these are the spots you want to be adding for the long term. Could we correct another 10%? Definitely, it's possible. But we also have to take into account that over the last 6 years, we've actually had two crashes. We had the crash of 2020, which is the fastest crash in history, and then we had the crash of 2022. Both times the markets corrected over 20%. So the odds that we're going to have another large crash within this 6-year time frame is not as high as it would be if we hadn't had those previous crashes. We can look at the markets from a technical standpoint, and I can give you guys a better idea of what I see and what zones or spots in the market I think would be good for a long-term ad. So the first thing that pops up to me is the daily chart on the Nasdaq or QQQ. Obviously this ETF tracks it, but you can see that this bullish green candle formed a daily fair value gap. We tested it once on the 13th of March, but just by a tick. What I think is actually happening here is this bear flag is breaking to the downside, and realistically we're coming down to sweep the internal low that we formed here on the 13th of March and probably going down to fill this daily fair value gap. So personally for my portfolios, I'll be learning the community about this as well, but I will be adding heavily to my long-term Nasdaq portfolios at the bottom of this daily fair value gap, which equates to $459.17. If we are able to drop below the sell side or the lows that we formed in early September of 2024, this will be another ad zone for me. And then I will go the heaviest in QQQ if we miraculously do end up entering a recession in the markets, and if we do end up sweeping this sell side liquidity from August 5th, 2024. So all three of these points, personally, I believe are good spots to add for the long term. The S&P 500 is in a similar spot. We do have this daily fair value gap as well that actually almost fully filled on those lows that formed on the 13th of March. However, we missed them by just a few ticks, if you can see here. So if we do end up going down and sweeping the sell side on the S&P and filling this gap fully, I will be adding to my SPY position. And then if we are able to sweep the internal lows that formed on the 6th of September at $539, $100, I will be adding there. And then of course, in between that level and the lows that formed on August 5th, anywhere in these zones, in my opinion, is a good spot to add for the long term. Not financial advice, again, just my personal opinion on where the markets are from a technical standpoint. If we look at the Fed watch tool really quick, guys, another thing we want to look at is the next FOMC meeting, which comes on the 7th of May. Right now, we have an 81.5% chance of that current target rate staying the same, meaning the Fed will not cut rates, and about a 20% chance almost that we will cut rates by 25 basis points at the next meeting. If we do get more rate cuts than we expect, I think that will be a bullish sign for the markets, and I think that that will actually end up being a catalyst to drive the markets back to all-time highs or close to it. I think we're at a point where investors are kind of tired of the sell-off in the short term, and any good news is going to be some kind of a driver to bring the markets higher. So whether that be something about Trump being more lenient regarding the tariff policies, or whether that be the Fed doing an emergency rate cut or more rate cuts than expected, anything can be a catalyst to move the market higher. I know you guys probably know this, but in corrections or in crashes, we tend to have violent swings to the upside as well as violent swings to the downside. That's how they generate liquidity in the markets. If we look at the crash of 2022, you guys can see that we did sell off for periods of time, and then we had big pumps to the upside. This was a liquidity generating event, trapping a bunch of people who went long in the markets. And then again, here in March of 2022, we had an almost 17-day period where the markets were pretty much straight green. A lot of people thought that the bear market was over, but again, this was a liquidity generating event. We ended up sweeping buy side liquidity just by a few ticks here on the daily chart, and then we ended up dumping again after having another rally in August of 2022, finally culminating with one final sell-off, bottoming on the 22nd of October. So my point here is that we obviously have some violent swings to the upside, even in crashes. This is how liquidity is generated in the markets, and investor sentiment flips constantly when there is uncertainty. Do not be surprised if we have violent corrections back to the upside before going lower. Again, do I know whether or not there's going to be a crash? Absolutely not. But I can tell you that you're much better off buying at lows than you are trying to chase price, buying at highs like this and waiting months and months, if not years, before you actually end up green on your positions again. For example, if you bought on the 28th of March, chasing price to the upside, you would have held for 469 days before you ended up being positive on your position again. So objectively, guys, it's much better not to chase price, and you should be buying on red days, not buying on green days. All right, so now let's go over some specific stocks that I'm personally looking at adding for my personal portfolios, with the number one focus for me being Tesla. Me and the community were adding Tesla between the 180 and 220 range, and we obviously benefited massively from this big pump that we had going into the elections. But now with all of the tariff fears and all the uncertainties and Elon's Doge situation, obviously there's been some volatility in the stock. But personally, I do not think this is something to be worried about for the long term. If you believe in Tesla's vision and what they're doing with robotics, what they're doing with full self-driving, and the idea that Tesla is going to grow into their valuation in the future, then I think this is probably a good spot to start adding for the long term to your positions. If we look at their metrics right now, Tesla is trading at an $847 billion market cap. And if FSD by itself ends up becoming what it needs to be, we could be looking at a potential $5 to $7 trillion valuation add for Tesla over the next 10 to 15 years. So that alone would put Tesla at a 5 to 7x of where it is right now. Not to mention, if Optimus becomes a thing, I think that Elon is being a little bit exaggerated with his valuations for Optimus, but he personally says that he believes that Optimus could be worth $30 trillion in the future, which would put Tesla at a much stronger valuation than it is today. This is not an excuse to put all of your portfolio into something. I see a lot of Tesla investors on X that identify as all-in Tesla investors, even though on paper that sounds really good, guys. If there is something that happens to Elon, there's always inherent risks to putting all of your money in a specific stock. Anything can happen. If you want to diversify your portfolios, I think that Tesla is at a pretty good spot here. We have fully rebalanced the daily gap after the earnings report in October of 2024. And if Tesla goes lower, again, I am happy to add for the long term, but I think anything between the 180 to 220 level is probably a great spot to add for the long term. Next, let's go into Nvidia, guys. This is also a big company that I would like to own more of in the future. I am a small holder in Nvidia, but I would like to add more for this for the long term. What I'm looking for on Nvidia is a sweep of all of this sell side liquidity. We have major liquidity resting below 100, below 97, below 91, and also below 75. And believe it or not, it is possible that we do have a recession and that major chip companies are going to have a big sell-off. If we can end up getting to the 75 level on Nvidia, that marks a 31% decline from where we're at. It is a big ask, but personally, I think anything below $90 and between 90 and 75 is a good spot for the long term. Anything in this zone, you're looking at adding Nvidia between a 40% and a 50% decline from all-time highs. Blue chip companies trading at these levels of discount are a no-brainer for me, so this is something I'm going to be looking for. And I will also be adding in smaller bouts below these more minor sell side liquidities down here between $100 and $90. But my main ads again will be between $90 and $75, and hopefully at the 74 to 71 level, which ends up filling this daily gap that formed in February of 2024. Going away from tech, guys, something that I have personally been adding for the long-term portfolios is Nike. We are currently down 65% from the highs, and I started my major ads around $73. I think it's possible that Nike ends up sweeping its sell side liquidity that formed during the COVID lows in 2020, which means that Nike would be trading below $60. And there is a 6-month fair value gap that is unfilled between the $45 to $40 level, though I think this is unlikely to hit. It is possible. Nonetheless, I think that this spot is a good spot to start dollar cost averaging for the long term into Nike. I know it's very tough to be buying things when they sell off at this great of a discount, but you have to think historically, when Nike sells off between 40 and 60%, it's typically a good spot to add for the long term. This has happened so many times in Nike's past. You can see here in 96, Nike had a decline of 60% before rallying massively. In 2008, Nike had a decline of 44% before rallying massively. In 2016, Nike had a decline of almost 30% before rallying massively. It happens time and time again. So I think this is a good spot to start adding for the long term. And I'm going to go over 2 more stocks here because I don't want this video to be too long, but one thing I'm looking at that is a little bit higher risk is Hims and Hers Health. If you guys don't know what this company is, all of the hair loss medication, weight loss medications that you can basically purchase for a subscription online, this company is a major distributor of that type of service, and they are now trading down at 60% from their highs. This is again a higher risk situation, and with Trump potentially announcing his pharmaceutical tariffs, this could be a driver for this stock to dump even further to even the $20 or $11 range. So do not be surprised if you get heavier discounts, but I think that this company has potential, massive potential for the future. They're currently trading at a $6 billion market cap. We could see this company trading at much higher valuations in the future. Again, it's a high risk, high reward play, but I think that adding this between the $28 range and the $11 range is probably decent for the long term. For me though, I am not going to be adding this position with more than 2% of my portfolio size. That is again my personal decision. You can do whatever you want with your portfolios, just my 2 cents. And then lastly, guys, let's go into crypto. Taking a look at the Bitcoin chart right now, you can see that we are trading into a monthly fair value gap on Bitcoin. And actually, if you look at the bodies of the candles in the monthly, we are holding the mean threshold of that monthly fair value gap perfectly right now. So a lot of people are freaking out saying that Bitcoin is going to collapse. Personally, I think this is a rebalancing of this monthly fair value gap. We have these order blocks here that were formed after the whole consolidation period between March of 2024 to September. So in my view, this is a good spot to start DCAing for the long term with the idea that Bitcoin is going to trade higher in the future. Personally, I do not invest more than 7% of my portfolio size in crypto. I haven't rebalanced in a while since the last time we added with the community was when Bitcoin was trading between 51 and 49,000. If you look at my alerts in the community on July 4th, when the fireworks were happening, actually was the last time that we added for our long-term portfolios. You can see here that Bitcoin was trading at major sell-side liquidity at 54,000. And I mentioned that I started my first DCA of the year. I think this is a good spot to start adding Bitcoin if you believe in it for the long term. So again, guys, another spot that I think is a good spot to start adding for the long term, if and only if you believe in Bitcoin for the future. So the stock that I'm personally looking to add that's actually high risk and high reward that I actually have been selling puts on in my community and buying shares is Riot, which is a Bitcoin miner. We have all this low resistance liquidity that has been building up on Riot since February of 2022, and we have an unbalanced monthly fair value gap here between the $24 and $27 range. So personally, I am looking to add this for the long term. Again, very high risk, not with more than 1.5% of my portfolio personally into this company, with the objective of all this LRLR being run eventually and trading into this monthly fair value gap with a low of $24.63. So if you were to add from here, you're looking at almost 245% gain, assuming that we're able to sweep all of this liquidity here. And so for me, this is an asymmetrical bet. Again, very high risk. If I lose in this position and it ends up going negative for me, then it's going to be a very small loss. However, the gains, if it does end up going in my favor, are quite high. So to kind of end this all off, guys, I am excited to see the market selling off. It's always an opportunity. We had a great week day trading last week. If you guys didn't know, I trade live on YouTube almost almost every single day, 3 days on YouTube, 2 days privately in my Discord community. The best days of the week I personally trade in the Discord. We had a banger trade on Friday that I took live in front of the community, and I think we're going to have some pretty good opportunities next week as well, especially if we're able to sweep this major sell side liquidity and fill this daily gap on the NASDAQ. If you guys are looking to trade live with me, we are currently running a free 3-day trial in the community. Link will be in the description of this video. I wish you guys the best this week. Please DM me if you have any questions relating to anything that I talked about in this video. Make sure that you like and subscribe if you can. Thanks again for sticking around, and I will see you guys on the next one. Peace.